We're about to see the bursting of the AI bubble. This is NVIDIA. It just had blowout earnings, but it's reversing off of this long-term trend line. This is all the price data that we have for NVIDIA. And again, a perfect parallel channel. It's reversing off of here after blowout earnings. About to witness the bursting of the AI bubble. It's like we saw the bursting of the tech bubble back in 2000 and 2001. I know I keep talking about the S&P making new all-time highs. Why? Because we haven't reached my target level, this trend line right here in the monthly time frame. It's coming in around 6,040. If we peak this month, if we go into December, it will, without reaching it, a little bit higher. It's in the high 6,000 area or so, just under 6,100. We could overthrow it and go into 6,100 and hit the trend line in the weekly time frame. Video, I'm going to be talking about why I believe we're about to move into a bear market and reverse off this long-term trend line. It's highly unlikely we're going to be able to get above this trend line, stay above it. We're likely going to form a market top and turn. And again, this connects the 2000 top and the 1929 top. Both were major peaks in the market. It's likely we're about to see another one here in 2024, likely before the year ends. Could see it. Haven't reached my target level, as I keep saying. Guess is we're going to reach my target level. Mid 6,000 area, or maybe overthrow it and go to the 6,100 area. It's a trend line in the weekly time frame. Watch this video all the way through. I would encourage you to do that. You'll understand why I believe that that's about to happen. You'll think we go a little bit higher to reach my target level in the mid 6,000 area, or on into the 6,100 range if we overthrow this trend line. Likely we're going to see a 50 to 65% haircut and drop back down to this midpoint beyond the point of the pandemic low, or worst case scenario, we drop back down to the highs of 2000 and 2007 at the 1550 and 1575. We went 25 points above it in 2007. Those are my target levels. I think we're going to bear market off of this long-term trend line. Watch this video all the way through. You understand why. Move into recession. The Fed's focusing on no rush, no hurry to cut, concerned about inflation, just like they were in 2007. Absolutely incredible. Watch the video all the way through. You'll understand. Quick review, but then I'm going to move into some stuff that I haven't shown you, explain to you why we're about to have this recession in the Fed. Now we're going to have this soft landing, and they're going to panic just like they did in 2007. At the top, we're going to get a 20% drop real fast, and the Fed will move and have an emergency meeting. It'll be too late. There are those telling us, well, we're not going to have a recession. We just had the election. President Trump's going to come in, and he's going to bring in these great economic policies, and we're just going to boom. And again, policies will take time to implement. They won't be implemented in time to stop the recession. The signals are already being triggered. It's going to inherit a recession. Wall Street thinks that right now. That's what Wall Street thinks. Going to have a recession. If you watch the video all the way through, you'll see why it's about to start. It's about to get real ugly. Now, yeah, I still believe we're going to go to new all-time highs. I still think we're going to reach this target level. When we reach this trend line, or maybe overthrow it, reverse, maybe at this blue trend line here, closer to 6,100 range, and then these divergences are going to play out. And then the AI bubble's going to pop. Said the dotcom bubble. There's no bubble? And we're told, this was a bubble, the bursting of the tech bubble after the fact. They were telling us it wasn't a bubble, but now we're saying, that was a bubble, but this is not. That's not a bubble. The longest bull market in history. That's not a bubble, but this is. The run up into in the 90s to this peak right here. If I zoom out a little bit, you can see again. This was a bubble, but this is not. Absolutely incredible. Now, last weekend I talked to you about the jobs report, and the jobs report is already pointing to recession. The Psalm rule's been triggered. I talked to you about that. I talked to you about deterioration in the labor market. Just got the jobs report from October, and again, the first 10 months, 2024, you got 1.7 jobs created. If you look at the first 10 months, apples and apples, first 10 months in 2024, you have over 2.5 million jobs being created, and this is with the revisions, by the way. They were much higher. The initial jobs were much higher. They ended up revising down hundreds of thousands of jobs. I talked about that last weekend. But the difference between the two is 838,000 fewer jobs are being created. Now, clearly pointing to recession, and I wanted to expand upon this a little bit more because, again, we have the same scenario that we had back in 2007. The Fed is completely blindsided that the recession is about to start. It's coming. Recession signals have already been triggered. And like I said, usually within 6 months, maybe a little bit shorter, just a few months, a little bit longer, maybe into 9 months. But we know it's coming. It's exactly what we had in 2007. And I just want to continue to point this out to you because I talk about something else I didn't talk about, but I wanted to review that real fast. This is clearly showing that, again, we're clearly seeing this weakness. Compare our current year to last year. What is the Fed doing? The Fed is focusing on inflation like they did in 2007. Blindsided by the coming recession then, they're blindsided by it now. They were blindsided by inflation. They told us it was transitory, kept rates too low for too long. We saw inflation rise towards 9% there and finally figured it out. They were blindsided by the inflation. They're blindsided by the recession. Absolutely amazing. Why am I telling you all this? Because a recession, the stock market is going to begin to price that in. The Fed is second guessing themselves, thinking inflation might be an issue. Did they do the right thing and starting to rate cut? And really, that's what's, we get this fake number right before the election here. Now, I'm not talking about the jobs report a couple of days there before the election. And that was probably a fake number, too. It was probably actually a negative number there. And let me just move this so you can see we got 12,000. That was probably put to be a positive number, but probably really it will be revised to a negative number when all is said and done. And that was because of the hurricanes and the, we had a strike going on and so forth. So, but this is the number right here. This number right here, this 254,000. It got revised down by 31,000 already. Probably get revised down even more. Again, the number, it comes out and everybody right after the Fed cut, and everybody's going in early October. We got the September number in early October, and everyone's going, everything's great. The economy is wonderful. The Fed cutting so aggressively, they're basing it on a fake number, on a fake report. Numbers are not trustworthy. So again, we just wanted to review that because I'm going to be expanding on that just a little bit here. Whether it is this stronger number that we got ahead of the that was reflected showing the hurricanes, labor strike, second guessing themselves now. Is clearly second guessing himself. It is the labor market fake number. Or it is the election. Everybody believes, okay, Trump pump won the election. Wall Street likes his economic policies, so everybody's saying, oh, now here we go. This election rally, I told you we were going to get an election rally, but again, it's too late. Trump's economic policies, while they may be good, they're going to take time to implement. Too late. Recession signals have already been triggered. I said Trump is going to inherit a recession right when he gets into office. And his economic policies may shorten the recession or may make it less painful. It's not going to stop it. It's going to take time to implement his economic policies. The conventional wisdom right now is, we had the election. It's going to implement these policies, and we're going to have the market go on, more years. And again, the recession, the stock market's going to begin to price that in. Some of those economic policies might help with the next bull market and the recovery of the economy, but the recession indicators have already been triggered, and we're not going to dodge the recession. So just wanted to review that real fast. And the other thing is inflation. Again, is Powell second guessing himself on the election with Trump, on the jobs report or the economic data, or maybe the inflation data? Again, a little bit stronger there with the PPI inflation report. Whatever it may be, Powell is second guessing himself. Now, the previous Thursday, we had Powell get a Q&A, made a little speech, and then he had a Q&A. And Powell created a sell-off the next day. The Thursday is when my signals warned we were going to get a bigger pullback. I warned you of that on Thursday, and then we gapped down hard on Friday. S&P's come back up and fill that gap this week. And I believe the S&P is in a topping process. I believe the S&P is going to make another new all-time high. We're going to blow off top. Once that's done, I think we'll see a a reversal, begin to usher in a bear market. But we have not reached my objective target levels. That's for a little bit later. I want to show you something. Watch this. It's very, very important. I'm about to show you. Fed is doing exactly what they did in 2007. I mean, maybe you weren't around in 2007. I was. Fed is doing exactly what they did back then. Back in 2007, the Fed was worried about inflation. They should have been worried about the recession. They were blindsided by it back then, too. Powell second-guessing himself. He did the jumbo cut initially in September. 50 basis points, and then we got another 25 basis points the last time at the election, and then right after that, Powell gets this Q&A here. Now the Fed is second-guessing themselves again, focusing on inflation. They should be focusing on the recession. The Fed is doing exactly what they did in 2007, blindsided. Powell said the economy is not sending any signals that we need to be in a hurry to lower rates. Wrong. Dismissing the signals. We had the uninverting of the yield curve, a reliable recession indicator. We had the Psalm rule triggered with the jobs report. We're going to move into recession very soon. Powell has dismissed that. He said the strength that we are currently seeing in the economy gives us the ability to approach our decisions carefully. It is looking at some fake number with the jobs report, not looking at deterioration of the labor market. I showed you, they're just blind to what is going on, as they usually are, just like they were blind about the inflation. If they waited too long to raise the rates, now they're waiting, making a monetary policy mistake, waiting to get more aggressive. We only got a quarter-point cut, and again, second-guessing themselves now. Room to pause if they want to, but he talked about the Fed being cautious and persistent inflation pressures. Talked about inflation being stuck and not coming down enough. He talked about inflation re-accelerating. Fed cuts too far. We have the Fed focusing inflation. And why I say the election could be an issue is because some of the things President Trump's talking about doing when he back into the White House, he's now convinced that some of those things are going to be inflationary. Yeah, I don't know. I mean, maybe it's a combination of things, but Fed is concerned about inflation pressures, just like they were in 2007. Now, currently, our inflation right now, this is the CPI data. We just got the October data. This is 2024 over here. We got a 2.6 reading, okay? 2.6-year reading on a year-over-year percentage change. Inflation rise up to the 9% area and then begin to come back down. Hopefully the recession is going to help with this. We'll have an inflation problem after the recession again. Now they're making a monetary policy mistake. They should not be focusing on the inflation, be focusing on the recession. They were blindsided by the recession or the inflation going into much higher. They are now blindsided by the coming recession, just like they were in 2007. So here, 2.6 for the CPI right now. 2007, the inflation was much higher, and we started a recession. Eventually, again, the Fed was focused on inflation. Eventually, the recession was dealt with the recession and the deflationary forces. Now, if we look back at 2007, in December of 2007, the Fed was focused on inflation. Right before the recession hit in November of 2007, it was 4.3%. When the recession hit, it dropped to 4.1%. It was much higher than what it is right now, the 2.6%. But they were focused back then on inflation, just like they are right now. They were blindsided by the recession that started the very end of the year there in December. And a cut right here in September of 2007. Market peaked in October, on October 11th, and 2 months later, the recession hit. It was very quick. The Fed was blindsided by it. Back then, again, the same nonsense that we're being told now. Oh, no, there's not going to be a recession. We're going to have this soft landing. It's a bunch of fairy tales. to have a recession. We have reliable indicators, recession indicators are telling us we're going to have a recession. Fed does what they always do, oblivious to this stuff. Market began to price in the recession with the October peak before it happened. The recession began right after that, immediately in December. Inflation steady for a little while. It started to drop a little bit, but then it surged even higher. But finally, recession dealt with it. 11 months after December, if we don't include December, 11 months after the month the recession started, in November of 2008. 11 months later, by November of 2008, inflation dropped down to 1.1%. After that, it went negative, though it initially went a little bit higher. And again, the Fed doing exactly what they did in 2007, focusing on inflation rather than focusing on the recession that began in December of 2007. Continue to make the same monetary policy mistakes over and over again. That's why I always say the Fed's policies lead to negative outcomes. Bernanke back in 2007 telling us there's no housing bubble. He said that over and over again. The Fed is blind to these things for some reason. About to have a recession, and Powell now giving himself room to walk back the rate cuts, even being less aggressive with them, as I've talked about, talking about risk of having to raise rates back up if inflation rears its ugly head. Again, they're blindsided by the coming recession. We had the deterioration in the labor market back then too. Look at the data. We had the recession begin in December of 2007. In 2006, the jobs being created were over 2 million, 2,071,000 to be exact. And 71,000 jobs. So again, for the whole year, we add up all these jobs, you get 2,071,000 jobs created in 2006. Now, if we add up all the jobs that were created in 2007, Fed was worried about inflation. Again, you have the same thing you have right now. We had over 2 million jobs created in 2006. 2007, we only had just over 1 million jobs, 1,115,000 jobs created. The deterioration in the labor market is in plain sight. From 2006 to 2007, we had, this is the full year. I'm just looking at 10 months, the 838,000 difference between 2023 and 2024. I'm only looking at 10 months worth of data comparing the first 10 months of 2024 and the first 10 months of 2023. For the full year, we had a difference of nearly 1 million jobs. 956,000 jobs, fewer jobs were created in 2007, and the Fed was blind to weakness in the labor market, focusing on inflation. Now they're focused on inflation, and it's much lower than what it was. It began cutting 2007 and right before the recession. The Fed was wrong and blindsided by the recession in 2007. They're going to be wrong about the recession right now that is about to start. You say, oh, the economy's strong, the economy's strong. Markets tend to peak with a low unemployment rate, is what we've recently had here. Still pretty much have, relatively low, and good economic data. Into the 2007 peak, we had one of the longest periods of job growth in history, one of the strongest periods of job growth as well at that time. Everybody was saying the same thing they're saying right now. Oh, we're going to have this soft landing. There's not going to be a recession. And the Fed was focusing on inflation. It was higher back then than it is right now. Picking up what I'm throwing down. Again, the green shaded area that marks the stock market peaking here in October of 2007. Immediately it had a 20.5% sell-off and ushered in on percentages the bear market right after that. By the way, when the market peaked in October, it had just began to cut September 18th back over here. And the recession began in December of 2007 right here. After December, to start the new year, the non-farm payrolls turned negative. We started getting negative numbers. Why I keep talking about, hey, we're going to end up getting negative numbers just before the recession or right with when the recession begins, one or the other, see negative numbers. With the accounting tricks that we've seen out of the Labor Department, it's still going to happen. Estimating by hundreds of thousands of jobs. Put lipstick on a pig, but the numbers will still be negative. And the numbers went after that initial number went negative. Again, they were all negative throughout the recession until the recession ended. Market started just before the recession officially ended. It marked it with this box here, still negative as the economy began to recover. The point I'm making is that, again, the recession was right around the corner. The Fed was completely oblivious to the fact that we were about to have a recession. Talking about the soft landing up until it became obvious to everybody that we had moved into recession. Saw it after the fact. Never saw the freight train coming at them. I think that December number is going to eventually be revised down negative. Now, maybe I'm wrong about that, but I'm just telling you, you are going to see a negative number with the jobs report just ahead of the recession or with the recession, and we could see that recession sooner than anybody thinks. And that's why I'm telling you to be watching for a market peak, because the market will begin to price in that recession. Bitcoin will price in that recession. Bitcoin's never had official recession with the bear market because we saw the Fed intervene and try to postpone or stop the recession from happening, doing QE infinity and beyond, dropping rates back down to nothing. They can't do that right now, and they won't gradually bring rates down. They're going to figure out that the recession is going to hit. Their soft landing nonsense is nothing but fantasy land. Just trying to tell you, the Fed and the Fed says, oh, we're going to have a soft landing. The herd and the experts believe that the rate cuts are bullish and their Fed is going to cut rates and we're going to move into this bull market. The rate cuts are bearish. I'm telling you this over and over again. Like I was saying a moment ago, Bitcoin's never had really to deal with the bear market and with the market having a bear market, because that has a positive correlation with the market, and never had to deal with a real recession. Markets dropped for about 3.5 weeks, and then they recovered as came in with QE infinity and beyond, and then the government passed out checks. It did the inflation that we currently have had, and continue to have. Just trying to point out to you, look, Fed started cutting rates in September of 2007, right here, 2007. The market peaked shortly thereafter, and again, I talked about that's a guideline. Maybe we see something similar to that. Maybe it goes on longer. Maybe it goes shorter. Well, it's going a little bit longer. Again, it's just a guideline. It's not a Nostradamus indicator. Fed began cutting. 3 months later, we were in recession. We'll see something similar to that. Go on into the first or second quarter, talk about triggered the recession indicators. It could be, 6 months. It could go a little bit less. Could be a little bit more on into 9 months. They are reliable recession indicators, and they are warning we're about to have a recession. The market will begin to price that in. All these negative jobs, the Fed never saw this coming. They never saw it coming. They were too focused on inflation. And that's exactly the same mistake they're making right now. That's why Powell's saying, oh, there's no hurry to cut. They should be cutting more aggressively recession to try to combat the inflation, recession. Never saw the recession coming. They kept rates for too low, too long. Inflation was transitory. Now they're keeping rates too high, too long, telling us the economy is great. No hurry to cut. Telling us we're going to have a soft landing. So again, if you weren't around in 2007, you wouldn't know this. I was. Same stuff they were saying back then, it's the same stuff they're saying right now. Soft landing, focused on inflation. The rate cuts are bullish. The same thing. Market went on to drop 58% for the S&P 500. Fed is doing right now what they did in 2007. They started with the 50 basis point cut there in September in 2007, and then they started cutting 5 basis points. That's what we got last time. Second rate cutting meeting. Recession had already arrived in December. They were still blindsided by it. Another 25 basis point cut. And then in January, the Fed focusing on inflation, blindsided, never saw the recession coming. Then they did an emergency meeting, 75 basis points. This is what we're going to see after realizes that we're in recession. They figured out after it has already begun. And that same month, January, they're meeting another 50 basis points and then another jumbo cut after that. This is what they should be doing right now, not this 25 basis point stuff. At the last meeting, they should be doing jumbo cuts. We're about to move into recession. Then in 2008, we got the jumbo cuts after the recession already started. We got more later on, Lehman moment and all the rest of it when the financial institutions were hemorrhaging. The Fed has a history of being blindsided and being late, and this is why I'm trying to show you. Look, oblivious, focusing on inflation, should have been focused on the recession. Now we're being told, oh, the economy is strong, we're not going to have a recession. They're still talking about this soft landing garbage, a bunch of baloney. It's a bunch of Kool-Aid for the herd. You know why the Fed had an emergency meeting? Because they were blindsided by what was going on with the economy, focusing on inflation. They panicked and they had an emergency cut of 75 basis points in January 22nd, and a week later, then they cut by another 50 basis points. The Fed panicked, playing catch up, just like they had those jumbo rate hikes when they were blindsided by inflation and kept telling us it was transitory. Now they're blindsided by the recession, and it's about to begin. Again, the Fed cutting rates September 17th, again, September 18th, 2007, we went higher for a few weeks. Here we've gone a little bit longer, moving towards a long-term trend line in the monthly time frame. I still think we're going to reach it. But after the Fed began cutting rates, market peaked and it dropped immediately by guess what date? January 22nd. That's when the Fed had their emergency meeting. Again, the market dropped by 20.5%. The Fed panicked. The markets began to concerned about the economy and recession, and the Fed was oblivious to it. They panicked and they had to play catch up and do jumbo rate cuts because they didn't see it coming. They were blindsided, just like they're blindsided right now. They were focused on inflation then. Inflation continued to rise. It rose up to 5%. Eventually, it was dealt with because of the deflationary forces and the Fed making the exact same monetary policy mistake that they made in 2007. Telling you this. I'm taking the time to explain this to you. No, everybody's telling us we're not going to have a recession, on all the experts. Oh, the rate cuts are bullish. The Fed did the pivot here, September 18th. Rates dropped, so did the market. After the financial crisis, we got the QE, round 1 and 2, 3, and you eventually got QE infinity and beyond and all the rest of it. The Fed has blown the bubble so big. It's going to be a day of reckoning. About to have it. Fed's policies lead to negative outcomes. They've meddled with the markets with this QE nonsense. Now we're going to see investors pay the price because they're blindsided by inflation right now. The Fed is going to having to do emergency cuts and do jumbo cuts because they don't see the recession on the horizon. Shortly after the Fed began to cut rates, we're being told by the Fed right now the same thing. Oh, the rate cuts, we're doing that to keep the economic expansion continue. Well, I'll tell you, once the stock market peaks, look at this. We peaked in October right here, and by January 22nd, just over 3 months later, we had dropped over 20%, 20.5%. That's when the Fed panicked. And when you see this start to happen again, when we start seeing the stock market get this dramatic drop, 2001, we had the 20% drop ahead of the beginning of the rate cuts. They just gave us a bounce, just like the cuts, they gave us a bounce, and then the Fed jumbo cuts and all that, the panic, it gave you a bounce, but then this happened. Financial crisis, and we're going to have another banking crisis, credit-driven issue. I'm just telling you, again, people, the same stuff they said back in 2007, the experts and the herd, it's telling us, oh no, we're going to have this soft landing and all the rest of the nonsense. Reliable recession indicators are telling us otherwise. Palm rule and the uninverting of the yield curve and others. People are saying the same thing right now about the AI rally. Oh, the AI rally. Oh, this time, like they did back with the dotcom bubble. This time it's different. Right after they began to cut rates, the market topped shortly thereafter in 2007. And throughout the duration of the rate cuts, again, the Fed was blindsided. Recession and had to do the emergency cuts in January of 2022, January 2022, 2008. Another cut in that same month because they didn't see it coming. The Fed should be slashing rates right now, and they are oblivious. About to move into recession. Oh, we're in no hurry. Rates, we're in a good place. The same nonsense that they said back in 2007. 2001, as the topping process occurred, we had already seen the sell-off of 20%, nearly 20%. Got a bounce with the rate cuts, but again, the duration of the rate cuts, again, the rate cuts happened. This is the Fed funds rate down here. Boom. The market dropped during the duration of the rate cuts, dropped over 50%. Over here, 58%. Time is going to be no different. Rate cuts are not bullish as the herd and the experts are telling us. As the experts, the big institutions are selling into the rallies. The rate cuts are bearish. And the market, in a recession, the Fed will begin to lower rates more aggressively. Even if inflation ticks back up, we're going to see the rate cuts, and that's what people don't understand. Inflation ticked back up in 2007. Finally, the Fed realized we were moving into an economic downturn after it already started. See the same thing happen here. You're going to see an emergency meeting out of the Fed. You're going to see the jumbo hikes come because they should be doing it right now. We got a quarter point. They should have been aggressively cutting at the last meeting. This coming meeting we're going to get. They're saying, "Oh, no hurry to cut." Do we get another quarter out of them, or maybe nothing at all? Who knows? They're completely clueless that the recession is about to start. Deja vu. It's 2007 all over again. I'm showing you all this because, again, the recession's about to start. The market's going to top, and it's going to start dropping, and you're going to see a quick drop of 20% or more. Once we get the peak in the market, the herd will panic, the Fed will panic, start doing these emergency cuts, and we'll get a bounce, and they'll tell us, "Oh, it's all over." The Fed is here to save us. The Fed that was oblivious to that was going on in 2007, their policies caused a lot of the problems in 2007. We had the whole thing with the subprime mortgages and the financial institutions and all that, but they also had their role in the collapse. It's going to happen again. It's going to happen a lot quicker than you think. And again, this happened fast. This happened pretty fast when it first got underway, and then we tried to get some rebounds, and then it accelerated as we got towards the end of the bear market. The herd saw everything's great. GDP, the unemployment rate, the economy, top on good news. Even though I proved to you, there is deterioration in the labor market, which is exactly what we saw in 2007. I'm taking the time to show you all this because we're about to move into recession. The Fed is blindsided, focusing on inflation. Market's about to peak. It starts dropping 20%, the Fed's going to panic and figure out, "Oh, gee, maybe we're not going to get a soft landing." They're believing their own propaganda. The herd is telling us, "Oh, no, this time is different. AI. That's what they said with the dotcom bubble, and this happened right here. People telling us right now, the herd, "Oh, there's nothing to worry about." The nothing to worry about crowd is going to get a rude awakening very, very soon. Ignore everything I'm showing you. I'm telling you, a recession is going to... The unrealized losses for on investment in securities for U.S. banks is now at $516 billion. $516.5 billion. Losses are 7 times more than the height losses during the financial crisis back over here in 2008. Continue to see quarter after quarter of consecutive losses, unrealized losses. 20% of this number is Bank of America, the second largest lender in the U.S. I mean, we're not have a banking crisis. We have all this going on. Banks losing on their investments in treasuries as the Fed raised rates. Saw a couple of banks go belly up over that, and again, it's not over because again, banks have huge exposure to the commercial real estate sector. The crisis going on there is going to spill over into the banks. These regional banks, they hold a lot of those loans. It's going to be the next banking crisis that we have. Again, a credit-driven issue, what usually surrounds a recession. Exposure to the commercial real estate sector is much, much bigger through the loans directly and indirectly through mortgage-backed securities. It's much bigger than what we saw the financial crisis and subprime mortgages and all the rest of it is going to be a bigger crisis than the financial crisis. We're being told, oh no, we're going to have a soft landing and we're not going to have a recession. Nothing to see here. Doing what they did. As the market was peaking and about to turn down, told us everything was fine. We're worried about inflation. Totally blindsided by recession and the coming financial crisis.